Thing about the states, though, this charging order I just told you about, it's not uniform. So where should you file your entity in the U.S.? This is what we look at. Taxes. Some states impose entity level of taxation. It's bad enough you got to deal with the federal government, U.S. federal government. Some states also will tax you on the amount of money your business entity brings in. So we're real careful on where we create our structures. We want to look at the liability protection that the states provide as well. What I just referred to here is not uniform. This charging order protection exists in a number of states, but in other states, they're free to take it and give it away to your creditor. So that's important as well. So we looked through all of this in making a determination as where to incorporate somebody initially. And what you'll see here is these are the top 3 jurisdictions in the U.S. when it comes to setting up an entity: Nevada, Wyoming, and Delaware. As long as you set up your business in one of those 3 states and then have it hold other businesses, you're going to be ensured that the protections that I'm referring to will be there for you should you ever need them. Nevada especially is the best state right now to incorporate in. They just recently changed their law last year in response to a case out of Florida, so they've strengthened their statute considerably to ensure that you do not have a rogue judge issue an opinion that is not founded on law. The way you do that is you tie up the statute so tight that there is no room for interpretation. Judges are fond of figuring out ways to work around the statute to create their own law in the United States. You have activist judges who think that they know better. And so they reach these conclusions that you would sit there and look at the facts and read through it and go, where did that come from? So they state their conclusion at the very beginning and they don't support it with any facts or how they reach that position. They say, well, that's the way it is. So legislatures have to be careful how they draft a statute to ensure that you can't do that. Nevada has done an excellent job in drafting their statute to protect you. So that's where we incorporate most people in Canada, is we put them in Nevada, especially for that charging order, because that's what you want, where it's the sole remedy. This is what you're looking for, what I just described. These are states where you create entities where charging orders are the sole remedy. Limited partnerships, and you just kind of look through them. They're in your book. I don't need to read them to you. These other states here are the dangerous states because they do not offer charging order protections. So if you were involved, if you owned an entity personally in one of those states, they could take it from you. A creditor could take that asset, that box from you, distribute the assets out to themselves. So it's kind of complicated in the U.S. on how you go about it, creating your structure to ensure that you have full asset protection. You have to understand the state law and how they approach the asset protection when it comes to these particular types of entities, just as it is up here, which you'll be getting tomorrow. Not all the provinces are the same, or federal, because you have the option of creating a federal entity or a provincial entity. They approach it differently when it comes to asset protection. Okay, why Nevada besides the charging order protections? Anonymity. Yeah, you can set up you can set up structures there where your name will not appear on record. That's one of the big reasons why people will incorporate in that state or set up an LLP or something, because your information can be held private. So if somebody wanted to perform an asset search, they wouldn't even know you're associated with this entity. When I create an entity in Washington State, or any other state besides Wyoming, Delaware, or Alaska, I have to put the individual's name on it, the owner of the entity or the manager of the entity. So let's just take Washington. I create a Washington LLC, my name's going to be associated with it. So if anybody goes on the Secretary of State site and say, Clint has a limited liability company, or Clint has a corporation, or he has a limited partnership here. Not so in Nevada. When you create them in Nevada, we'll utilize, there's an attorney in our firm that's on, I don't know how many thousands upon thousands of entities there. If you went to the Nevada Secretary of State site, website, you typed in A.T. Mathis for officer or director, you're going to have, I don't know, 150 pages of entities where he's filed on. Now what he is, Toby Mathis, he's a partner in our firm, he's a nominee. In Nevada, you're allowed to create an entity where you put this attorney's name down as a nominee for filing purposes. So if somebody's sniffing around, just they want to know what's going on with you, you don't pop as being associated with this particular business because you have a nominee protecting you. Now the way the nominee works is that the nominee's on there for filing only and then he's off. You're the person who's actually in control. But from the public's point of view, they don't know about you. That's why people will set up Nevada entities for this anonymity that it offers. And it's even on the filing. If you look at the filing of the entities that we set up there, it says A.T. Mathis, comma, nominee. So it tells people that he's not involved with the entity. He's just there to mask our client's actual ownership in that entity. So that's a level of protection that many states do not provide you. Another benefit of incorporating in Nevada is there are no state taxes on the entity as well. So you're always, when you're investing in the US, you will have to pay federal tax, but you will not have to pay state tax if you set it up in Nevada. If you were to set it up in California, they have a state tax you have to pay. Florida has an entity level taxation. A lot of states impose a state entity level of taxation on top of federal taxes. So it's important that you choose a state that does not do this. Nevada is one of them that does not have it. That's why we go there. So no franchise fees. You're able to self-deal. These are just a number of the benefits why you would incorporate in this particular jurisdiction. I mean, really it gives you a hammer when somebody's coming after you to protect yourself because they know how difficult it is. There was a case that was just handed down 3 weeks ago, another Nevada entity case where the member was sued individually, a judgment was entered against him, and the creditor tried to break his LLC and the court said, we're not having any of this. The only thing that creditor is entitled to is a charging order. We're not giving them the LLC interest. End of story. See you later. So that just reaffirms their commitment to protecting people who set up their businesses there. And so for many times what we'll do is as follows. As a Canadian, we'll have you set up an entity, either an LLP or a triple LP in Nevada. This is your base of operations. Now, you think about investing in the States? Sure. What state?
Well, obviously Nevada.
Well, no, you don't have to buy real estate there. This is just where your base of entity operation is. Have you thought of a state?
Arizona.
Okay, think about buying in Arizona. So, the way it would work is you would have this entity set up in Nevada where both of you are on it as the members in your LLP. And you both have complete control over it. Now, this entity itself is not going to own the property in Arizona. It's not going to do that. Why is it not going to do that? Because in the States is that if you want this Nevada entity to own the property in Arizona, you have to register it in Arizona. And if we register it in Arizona, then we're going to lose the protections that Nevada provides. So there's a reason why. This is our home base. This is where we operate from out of this Nevada company when we're investing in the US. From here, when you go into Arizona, what you will do is you will create an Arizona limited liability company to own your house. All right, remember I said you'd use LLCs, but you're going to use them in this manner. As a Canadian, you do not want to own the LLC directly, or it will create tax headaches for you. So you can own LLCs indirectly, and the way we create these LLCs is they're set up as disregarded entities for tax purposes. That is, they do not have to file a federal tax return. And in fact, the owner of the LLC is a US tax-paying entity. So from the federal government's point of view, there isn't a Canadian owning it. It's owned by a US tax-paying entity, which is that limited partnership. It's the one that files the US tax return every year. So what we have with our Canadian clients is we have situations such as this, where they have created LLCs, a Florida LLC for their Florida real estate. They have their Arizona LLC for their Arizona real estate. Let's assume they invest in California, so you have a California LLC for their California real estate. All of these LLCs point back to that Nevada limited liability partnership. They all point back to there. Now, from an asset protection point of view, if anything happens right here at this entity level, The only thing our clients are exposed at is that one asset, that one leg. It disappears. These other two remain protected. But all items of gain or loss are reported down here and then passed through to you to the Canadian side. And of course, you will pay income taxes on the US side because you will have to file for an individual taxpayer identification number, which I'm going to talk about in the next section. Otherwise, you're going to have 30% withholding, and you don't want that. So you'll get an individual taxpayer identification number, file 1040 NR every year for your income generated in the US, and then the rest gets passed down to you. So this is the preferred structure if you're going to need to invest in the states. Now, if you say, Clint, I'm only going to invest in one state, and you don't see yourself investing in a multi-state strategy, would that change my structure? No. I would still keep it this way. Because if you follow this line of reasoning, which is if I'm going to invest in multiple states, then I need multiple LLPs set up. And you go like this: LLP number 1, LLP number 2, and so forth. Number 3. You know how many tax returns you have to file in the US? 4. Personal and 3 partnership returns. Why complicate life? Okay, again, you would just say, if I was doing is invested in Nevada, then if that's where you found that market attractive, again, create your one LLP, which is designed to be the buffer to ensure that everything flows down to you in the most tax advantaged way, and then create your Nevada LLCs to own your various Nevada investments, just like this. So we're set up that way. Again, now you only have to file 2 tax returns. This is a structure that we utilize a lot, even for our US clients. This wouldn't be an LLP, it'd actually be an LLC. We have clients with 15, 20, 30 limited liability companies, all flowing down into one holding LLC is how we refer to it. And of all those entities, you only have to file 1 return for all those LLCs, just 1, because the other ones are disregarded for federal tax purposes. The LLC is the most popular form of business entity now in the States because of that, because you can elect how you want it treated for tax purposes. I mean, that's basically, besides 2 corporations, all of my entities are LLCs that I've created for that reason. But we have to buffer you. That's why we use that limited liability partnership. Does that make sense? Yeah.
That makes sense. Yeah, I'm just not clear on in our world, it will be the LLC, the holding company that we have then. What value assets are held there? Nothing?
Which value assets are held in the LLP is the question. The assets that are held in your limited liability partnership, so this is a Nevada LLP, the assets are the membership interests in each of these LLCs. It's the sole member of these various limited liability companies. That's the asset that's held by that LLP.
So if you lose one of the legs, one of the LLCs and whatever...
So you lost this.
Right. Can you claim that loss within your LLP? Because you're paying taxes only within the LLP against that leg. Can you claim that loss in your LLP?
Absolutely. The question is, how does the losses work from the LLP standpoint? This structure that I drew out for you, from a tax standpoint, let me show you what it equals. This is LLP, and you have separate LLCs that are owned by this one LLP. From a tax standpoint, that is equivalent to one LLP owning 3 properties without the LLCs. It's the same. The difference between the two is that in option number 1, we're using the LLCs, the most you stand to lose is 1 property or whatever's in that one LLC. Whereas in option number 2, where you put all the properties into one entity, the whole thing is at risk. But from taxes, it's equal. It's equal.
So I guess I understand that, I appreciate that. My question though is if you've effectively got no value in the LLP in and of itself, how do you have a deduction against that to attend to your loss?
Okay, so how is it if you have no value, there's no deduction there? The LLP has value from a tax standpoint because when you file the partnership tax return, on that partnership return, the assets that are held in the LLCs are carried on that partnership return as if the LLP owns them directly. That's how it's treated. So when I say the LLC is disregarded, the IRS, they don't even see the LLC. They say, oh, the LLP owns everything. Yeah, you bet.
I don't know how to phrase it, but based on previous history tax laws, and the changes occur over time, how does that affect, or has in the past affect the LLP accordingly?
How has the LLP changed over time? It hasn't, because it's always been treated as a partnership. You all have partnerships up here, pretty much the same, the way they're treated.
So let's say 20 years from now, legislation changes, can it affect the LLP accordingly?
If legislation changed in 20 years regarding partnerships, could it affect the LP? Possibly. Where I think the way it might be affected would be from the US side is on the withholding requirements, what I'm going to talk to about in the next section, how the IRS may be concerned that people are, again, pulling money out of the states. Well, yeah, I mean, the thing is that can Canadians come down to the States and buy and sell property and not pay any federal income tax? Absolutely. If you're not dealing with a broker going through escrow, there's a possibility if you're just selling to an individual and he's paying you cash, you can sneak the money out. Okay.
But I mean being legit and you want to protect yourself on the LLP.
Yeah, being legit. The only thing I would say is that they're going to impose more reporting requirements to ensure that the adequate amount of income is being reported. Pretty much locked. These are what the limited partnership, the structure of that, is one of the oldest forms of conducting business that we have. Canada and US law both stem from English common law. And so our legal system, there's very many similarities between the two up until we get to LLCs. Now you all have an LLC up here as well, but it's treated, I believe, as a corporation. Not as we treat it in the States, which could be a corporation, partnership, or disregarded entity. So we have a few more options there. Comes to this.